This is our Forex blog for November 23rd, 2011. And like most days, we really want to buy the strong currencies versus the weak and sell the weak currencies versus the strong. You want to look for patterns that have real-time strength in the dollar, that the daily, weekly, monthly trend is also up. And when all four time frames are all lined up, that trend's likely to continue. And you pretty much know it's going to continue statistically when and they don't go up for 5, 6, 7, 10 hours at a time. It goes up, and then it has a counter trend move. It goes up, has a counter trend move. As long as the upwards move is more, and I like to say, 1/3 to 2 times, or I rephrase that. As long as the weakness move is half or 1/3 as much as the main momentum wave, then the trend's likely to continue. You can see that's what happened here, 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 especially here, there's almost no weakness. That's a trend that's likely to continue. When downtrends happen, you can see here, almost no strength at all, a little bit of strength, less weakness. That strength's likely to continue, and it does. Keep in mind the weekly trend's just barely up, the monthly trend's down. You have kind of a mixed signal here. The Australian, it's weak all day, so when you see, weakness and then only one 5-minute bar of strength, that weakness is likely to continue because of how weak it is. You could be looking to sell the Australian dollar because the dollar is strong. The last move in the Australian was weak. The daily, weekly, monthly trend is down. Coming up to 5 o'clock right here is a pretty high probability sell in the Australian dollar. And you can see that's exactly what happened. This thing's been going sideways. At 5 o'clock, it broke down and fell from 97.45 all the way down to pretty much the whole number, which is one of my second Fibonacci profit targets. I do Fibonacci analysis for about 30, 45 minutes every night so that you don't have to. My Fibonacci areas show up on your charts. So whether you know how to do multi-time frame, multi-fib clusters, support resistance type analysis or not, doesn't matter. These are areas where the market's likely to stall. If an area is underneath the lower containment band, it's even more likely to stall. As you can see, it came down here, some strength came in, you had a nice little 30 pip counter trend move. But that's how you use a currency meter. You want to find one currency that's likely to become strong again, like for instance, extreme strength here at 5. And then we had about 40 minutes of weakness, and then the weakness started to dissipate. Because this trend was so strong today, it was likely to resume itself coming up to before 7. So you want to find a currency that's likely to become weak coming up to 7. Now here's one that I would say the best odds of that is a Swiss. You had about an hour and a half of weakness, followed by only half an hour of strength and far less strength than weakness. The dollar CAD coming up, the dollar Swiss coming up to 7 is a very high probability trade. Zooming in on this chart here, here's 7. Notice the currency is going up with a lot of statistical momentum. It is underneath the lower, or I should say the upper containment band, so it hasn't gone up statistically too far. You draw your trend lines over those bars lows on the pullback, and guess what? At 91.80 you go long, and as the market goes up, it comes right back up to the previous high. Double tops, double bottoms are major resistance areas. This also happens to have a monthly pivot and a weekly pivot level right there. And once the momentum runs out, you might want to get out of half your trade here at 97. You would have been in this at 80. You made 17 pips. And whether you let our trailing stop get you out or you just kind of got out when it went sideways here, the upwards momentum started to really fall right here. As you can see, it's right up at the high, but the momentum is falling. What that's telling you is that because we compare the dollar to every other pair and the Swiss to every other pair, this currency actually appears to be going up right here. But other dollar pairs are losing their strength. Other Swiss pairs are, losing their weakness or gaining a little bit of strength. In other words, the dollar is kind of getting a little weaker against other currencies. Maybe against the euro dollar, it's starting to go up, which means the euro is stronger and the dollar is weak. Whatever the currency, or across all the currencies. And this lets you know what your odds are in any given bar. It's an incredible tool that you won't want to trade without. So coming up to 7, let's find another one. The New Zealand was weak across the day. It had a little bit of strength here at 6, and then intense weakness here. Coming up to 7, there's really not that much strength. The last momentum move was to the downside. the weekly and monthly trends down, you certainly could consider looking for a sell at 7 o'clock in the New Zealand dollar. So looking at this currency, it had started the day underneath the hourly, had a nice 70 pip drop. You draw your fibs on there for added increasing your odds and your probability. The 50% retracement is always a high probability trade. And you can see it came up and it had 2 bars of really intense strength, and then it fell off a cliff right here. So you have a counter trend sell signal right here. The 50% level is a very high probability place to sell. We also had a weekly pivot level here. The 62% is just above it. Previous day's low is just above it. If you want to go short and have a stop that's not likely to get hit unless this trade really is not going to work, you put it above all the resistance areas here, and most of the time the market will retrace half of the previous move. That's usually a minimum profit target. So this is a very high probability place to look to get out of half your trade, especially once it hits that area and the weakness starts to fall off. You're out, and you can always hang on to trades longer, or what I do is trade them kind of as scalps. This is a very high probability place to get in. Out of half there, my trailing stop would have got hit. It went up, had less strength on the way up than the previous weakness. The daily, weekly, and monthly of this combined currency is down. You draw your trend lines underneath the bars here. And notice on this one, it falls pretty rapidly with a lot of weakness, and then it goes sideways here. I would always exit half my trade when it goes sideways, and then put my stop right above the bars on the other half. And most markets make 2 wave moves. So when it starts to continue, you're already out of half with a very small profit. You're in here at 21, probably out of half at 08. You made 12 pips. And then when it comes down to the lower fib targets down here, very good place to get out. You got out of the second half at 90. So you made 30 pips on half, 12 pips on half. If you average those 2 exits together, you netted a little over 20 pips. And that's how you trade with these tools. The currency meter is a wonderful tool. Here you have incredible strength in the pound followed by very little weakness. That strength is likely to continue. It does, coming up to 645 or so. So what currency would have been a good one to sell at 645? The Australians, okay. I think the Swiss is an excellent one. Let's just bring up the pound Swiss just to show you how powerful the currency meter is when you use it correctly. And I've started to focus more on, how to read this. I've been using it for years. I created it for myself. What time are we looking at here? Coming up to 7. Now this currency already has exploded. So that's a little bit of a downside here. You would usually want to prefer waiting for a 38% pullback like right here, which is a little bit later. But nonetheless, this had pretty high odds of going back up, and it did, but it didn't go up that much. As you can see, this pullback right here, it went up and it went sideways. So you had every opportunity to make anywhere from 8 to maybe as high as 20 pips on this, or 18 pips. And I'll quickly put our range or FX Trend Pro on this, just so you can see the statistical strength. As you can see, extreme strength on the way up, pullback with almost no weakness. And this is a great opportunity. I'll finish the blog post today by showing how our range bar charts work. If you put ATR on your charts, it shows you how many pips per bar, whatever time frame you like, moves. One of them shows the average and one shows the median. You can Google median versus average if you want to know what the difference of those are. But I kind of look at both and kind of take the middle ground or the average of these two. So about 6.5 pips, or closer to 7 pips per bar, is how much the pound Swiss moves over the last 20 days from 3 to noon. So you could use the 7 pips per bar chart to come up with a very good range bar chart. You would put 7 R, which is pips per bar, and I'm going to remove that other tool because it's not designed to work on range bars. And it's going to download tick data, and you can find trades on range bars that you just simply can't find on 5-minute charts. You can see here. Hopefully, I've had some weird e-signal issues. Okay. Sometimes they're a little slower. Let's go back to 5-minute trade. Try this again. 7R. There we go. All right. So when this was extremely strong earlier, you had every opportunity to get into this trend. Here it had a lot of strength. Pullback had very little weakness, as you saw in the previous 5-minute bar move. You have trades in this where you don't really have in the range bar, and if you had bought that pullback coming up before 7 right here, usually after a 4 or 5 bar pullback on a range bar, the first bar that goes green, if you buy it when it goes a pip above the high, it's a pretty high probability trade. You would have been in this at 09. It goes back up, fails at the high. You never know if the market's going to go above the high or not. A lot of times there's major selling there. When it comes back again, there's still whoever is selling, or the collective group that was selling before is still there selling. They don't believe it's going to go higher. The markets are an auction process, so they're looking to sell here, and they do. So, typically you want to, at the very minimum, get out of half your trade when it goes underneath that bar at 14. You're in this at 09. You didn't make that many pips. Maybe after the spread you even lost a pip or two, but you didn't lose much. And that's, the whole key behind using range bars. This is set to a very high probability number of pips per bar, and you can set that to anything you want. If you like 15-minute or 30-minute charts, maybe you want a 20 pips per bar chart. It really makes looking at the chart clear, because there's no, some 30-minute bars or 15-minute bars don't move that much in terms of pips, but they take up space on your chart. By using a longer-term chart with 20 or 30 pips per bar, you really get a feel for, and you can see back, today, yesterday, the day before, Sunday, half of Friday, you really get a feel for the market. And you can see this is a 38% retracement right here, which is the reason why that the market kind of stalled there and ran out of steam. This is in a clear downtrend. Today, the pound happened to be strong and the Swiss happened to be weak, but it's a counter trend wave. And so it's not as much likely, odds-wise, to continue up. And your trades to the long side are much less profitable than, odds-wise, than your sell trades.